Good morning, everybody, and welcome to the latest DFDL tax and transfer pricing webinar. My name is Jack Sheehan, and I'll be your moderator for this morning. Next slide, please, Sigaline. Before we start, just a quick introduction to who we are and what we do. DFDL is a regional tax and law firm. We're based in 9 countries. We've got offices in 9 countries, or 12 offices over those countries, predominantly in Southeast Asia. We've got offices in Thailand, Cambodia, Philippines, Myanmar, Laos, Indonesia, Cambodia, Vietnam, and we have 1 office in Bangladesh, in Dhaka. As far as it goes with our tax practice, we have a full tax and transfer pricing team. I'm based in Bangkok. My colleague Christine is based in Singapore. My colleague Jonathan is based in Bangkok also. So quick introduction to our speakers this morning. Jonathan Blaine is a tax director based in Thailand. Jonathan is both a qualified lawyer and a CPA, and he's been doing international tax for many years, and he's very experienced in Thai and international tax matters. And my colleague Christine Schwarzl is our regional transfer pricing director based in Singapore. Christine has lots of experience in structuring international groups around transfer pricing, head office, advanced pricing agreements, and all things transfer pricing related. So this morning, we're going to give you an update on recent developments in Thailand, looking at recent tax law and regulations, and also looking at recent transfer pricing developments. So just some housekeeping rules. And if you've got any questions, we will take the questions at the end of the Q&A session. There is a function. If you look on the top of the screen, you will see you'll see a bubble with a question mark in it, and in there you can post any questions that you have, and we will try to deal with them all before the session ends. So not to waste too much time, I'm going to hand you over to my colleague Jonathan, who's going to discuss some recent new tax developments that are happening in Thailand. Jonathan?
Okay, sure. Thanks, Jack, and thanks for the introduction. As mentioned, my name is Jonathan Blaine. I'm a director here in the tax practice based in Thailand, with many, many years of international and domestic experience here. What we want to do is just do a quick romp through recent developments, recent changes, talk a little bit about some change or modifications that have been implemented this year, question whether they'll be available for next year, and this kind of thing, and then give you maybe a couple of tips on some maybe net operating loss utilization planning that people might be interested in trying to pursue over the next 12 months or so. The first thing we want to focus on is the implementation of the e-filing system. As many of us are hopefully aware, there's an e-filing system for returns that streamlines the process, make things much simpler. And in the time of COVID, when people aren't supposed to be in the offices very much, etc., this has proven to be quite a beneficial process and way of doing the filing of the returns, and is actually quite consistent with what we've seen internationally. Some countries mandate that all returns be filed electronically unless there are special circumstances. So it's good to see that this is actually, the uptake on this is actually quite strong and being implemented. As we saw, most of the tax returns can be filed except for the PND 93, which is an advanced personal return, so it's not really, and petroleum business tax. The system works 24/7. It's currently only available in Thai language, but that's normally not too much of a drawback because most people have somebody who can do the Thai language part of the filing. The payments can be made through different systems or different processes, so at ATMs or e-payment or counter services, or through the Tax Smart card, which is like an internet card that they've set up. Given the COVID situation and the filings and the step back still. We're still on the e-filing slide, so if you can go back, yeah. So because of the implementation of the e-system and because of COVID, et cetera, there were extensions granted for the filing of certain returns. So, for example, VAT and withholding tax, et cetera, which are normally due on either the 7th day or the 15th day of the month following the close, those were extended. And so I think for now, the only one that's still technically open is November's filings can be done by December 30th instead of by the 7th or the 15th. But what's also interesting in this context is being aware that there may be difficulties in getting people into position and getting information together, et cetera, on these new systems for e-filing. They've waived penalties or reduced penalties for late filing. So if it comes to VAT return or SBT returns, then if those are filed late, as long as they're submitted within 3 months of the extension, then if all the tax and the interest is paid, their penalty is waived completely. If you don't pay all the all the tax and the interest, but you pay at least 25% of the tax due, then the penalty will be reduced to only 2%, which is actually pretty good. So again, these are very, very nice extensions to take advantage of if necessary. So if December 30th is the deadline, then you have 3 months extension beyond that. So it's a nice benefit to have been granted by the revenue purely in recognition of the fact that people are operating in very challenging times and getting all the documentation. Implementing this kind of filing process in the first place may be a challenge, but now trying to do it in the context of COVID, where people are sort of scattered in office, not in office, et cetera. So that was quite a nice benefit to be granted under that process, and I believe that there are lots of taxpayers who are taking advantage of these late filing capabilities. Okay, so if we want to move to the next slide. So again, what we want to do is just touch on the COVID relief measures that were granted, and not specifically because you may not be aware of them, because they mostly applied to last year, but just to be aware that they were there, and now to query, are we going to see any of this in 2022 or not, right? There were obviously benefits granted for withholding taxes, right? There were reductions on certain types of withholding. For certain types of income. Often the percentage of the withholding was cut in half in many cases. Then there were other company taxes that were put in, that were granted relief. So there were fast VAT refunds for good exporters, and this is in recognition of people having cash flow issues during the COVID period, especially last year. Certain donations that are made through e-donation system, and a corporate income tax filing extension was granted for last year as well. There were some special SME related benefits that were granted, so cost salary reductions and interest expense deductions, et cetera. Those again we're not hearing any noise on whether those will be extended, but I'll discuss that in just a moment. The one that actually has carried over quite a lot and will run through December 30th this year, or December 31st this year, is the property tax reduction, the transaction fee. That's supposed to expire December 31st. Now the question becomes, can we expect any of this to be extended for next year, for 2022? I would say in general, probably not. However, as we've noticed over the last week or so, we have a new variant here, and no one knows what's going to happen with that. And I think everybody's in a bit of a panic, and they'll be in a panic for maybe 2 or 3 weeks until they sort out how serious this is. But when you've got countries like Israel and Japan and other places completely closing down all foreign travel, then query what's that going to mean for Thailand, and how are they going to accommodate that, and are we going to end up with potential lockdowns again? I seriously doubt that they can, because I think the economic situation is just so stressful at the moment that a full lockdown just would not be feasible and acceptable. But then again, we don't know. So I would anticipate, if there are significant disruptions and significant economic impact, and or people have to move back to working from home most of the time, that these extensions and reductions may be granted. I would expect more so that extensions, filing and things like that would be granted than actually economic relief. But there may be other economic relief packages that may need to come in depending on how things work out economically over the next few months for Thailand. So all I can really say is sort of watch this space, but don't watch it, just watch it with a fully open mind, because we have no idea exactly what they would target, and they would clearly be tailored to the needs of the economic situation, I think. Okay, we go to the next slide. So what I want to do now is shift a little bit and talk about the OECD BEPS update, and some of you may be aware of BEPS. A lot of people I find are not, I've had sort of heard of it, or heard the phrase BEPS, and have absolutely no idea what it is. And because it's going to have substantial impact on domestic activities and or reporting, etc., for all Thai corporations, or most Thai corporations and businesses, I think it's important that we have at least a framework or an understanding of what this project is. So there was historically there have been a lot of issues and a lot of noise around the ability of international businesses to shift profits from one jurisdiction to another, normally from high tax to low tax jurisdictions, thereby eroding the base of the higher tax jurisdictions. And this has been seen as problematic for many, many years. It's not something new. I mean, the complaints about this have gone back 40, 50 years sometimes. But after the global financial crisis in 2007, 2008, when all of the developed countries' revenue departments saw their tax collections fall significantly, they decided that they needed to get together and do something about addressing this sort of base erosion and shifting issue. And this is when we started getting testimony in front of UK Parliament and the US Senate, etc., for all these big international companies, Starbucks and everybody else, all Google and you name it, they Apple and everybody else were all getting called up and sort of politically shaped. Whether that's appropriate or not was another discussion altogether, for actually utilizing the international system to avoid tax. And so there was a belief that this needed to be addressed. So it was taken up through the G20 and the OECD, and they put together an entire program called Base Erosion and Profit Shifting, so BEPS program. It's a quite extensive program, and there are 15 action points. We won't go through all of them, etc., because they would be quite an extensive discussion, and the volumes of paper that they have produced, the OECD, on these topics is massive. But Thailand specifically has obviously taken up part of this program, as have most countries around the world. And there's a sort of minimum standards or a minimum group of activities that out of those 15 action items that Thailand has agreed to sort of take up and implement first, along with lots of other countries. So Thai companies are being impacted currently, and have been impacted for the last maybe 3, 4, almost 5 years in some cases, when it came to things like harmful tax practices. And so harmful tax practices were use of incentive programs, and we know that in Thailand there are lots of incentive programs that are granted by the Board of Investment and the Thai Revenue accordingly, which would attract investment to Thailand at lower tax rates and give tax holidays, etc. Some of those programs were seen as being abusive because they would attract investment from higher tax jurisdictions to the lower tax incentivized jurisdiction. So there was a focus on reviewing all of these kind of programs, many different countries through peer review, etc. And there were some practices in Thailand, some incentive programs in Thailand or schemes in Thailand that were deemed to be harmful and had to be adjusted. So we'll take a look at those in a few minutes, but I'm sure some of you are aware of some of those changes and modifications or cancellations. In addition, treaty shopping and treaty abuse has been around for a very long time. And so modifications are being made to tax treaties globally to address some of those abuses. So there are provisions for modification of permanent establishment to make the concept much broader than it used to be, to catch sort of artificial avoidance of permanent establishment through like commissionaire or other types of arrangements. And then also utilization of, having tax transactions, entering into certain transactions where the principal purpose of that transaction is the avoidance of tax, and it really doesn't have any other economic motivation or actual business motivation. And so there's an introduction of principal purpose test to determine whether treaty benefits are available or not. And this is actually quite technical and quite expanding and difficult area to get into, because determining whether something is a principal purpose or not is very facts and circumstances. It gives the revenue a lot of power to attack certain transactions in certain ways, and so its uptake is quite it's being taken up quite a lot by most of the jurisdictions, because the tax authorities are quite keen to be able to use this to deny treaty benefits in certain structures. Then, of course, we've seen transfer pricing rules, and we can touch on this. Obviously, Thailand's transfer pricing rules were not statutory in nature historically, and we've seen that modification come through. And part of that, again, is based on the BEPS push to make the transfer pricing rules statutory and appropriate for international standards and adopting international provisions, etc. In addition, there are information reporting and information exchange requirements, and so Thai companies are going to be required to report all kinds of information to the Revenue Department, which will then exchange it with other revenues or et cetera around the globe. And this information reporting can be quite burdensome, even if you have limited reporting to do. There may be requirements. In addition, the Revenue Department may, and we've heard some noise around this, they may not want to make distinctions between who has to do the reporting and who doesn't. So they may just require everybody over a certain size of company to do reporting for information gathering purposes, etc. So we'll see where that sort of expands on into. Okay, if you want to go to the next slide, please. So again, recent developments that have come out of this BEPS project in Thailand are obviously the introduction of e-commerce taxation. There were some issues around this historically, especially when it came to taxation of the income side, and that hasn't been completely solidified. But the e-commerce taxation legislation came in recently to address the transactions that were where taxes were easily avoided through doing e-commerce. As part of the treaty shopping provisions, there obviously the treaty provisions between bilateral tax treaties would need to be modified, and that process was seen as impossible to do with all of the treaties around the globe. So a multilateral instrument was created, and all of the countries who sign up to the multilateral instrument will have their tax treaties modified according to the provisions of the MLI with anybody else who's signed. So it'll be an automatic change in the treaties without having to renegotiate the treaties on a bilateral basis. Country by country reporting was implemented in Thailand as part of TP legislation. Christine will touch on this as soon as I jump off here and turn it over to her. And there are some issues around this also, because the MLI has not actually been ratified. The multilateral instrument hasn't been ratified, so there are some hiccups around country by country reporting, or how that can, what will happen to the information, etc. As mentioned, under the harmful tax practices, for those of you who had an IHQ, an international headquarters incentive, you will obviously, no doubt, still be hurting a little bit from the way that was canceled unceremoniously by the Revenue Department, not by their choice. I mean, they sort of were obligated to do it, They did replace it with the International Business Center incentive, where the benefits are not as generous as they were under the IHQ. And they provided a transition of that, but that again came out of this BEPS project and has caused some real good benefits for particular companies who want to establish an international business center in Thailand, and have caused some headaches for those who had an IHQ that no longer don't qualify or can't utilize the IBC. In addition, when we talk about reporting, this is more on an individual level, but there's a common reporting standard now, which is quite similar to, if anybody's heard of FATCA before. This is sort of a global FATCA process, but the implementation of this has been delayed, and the OECD, I think the OECD just recently gray listed Thailand again. For lack of having implemented this process. My understanding is this is coming soon. It should be implemented because obviously Thailand doesn't want to be on a gray list. From a corporate perspective, it could be problematic from a reputational perspective because as long as Thailand is on a gray list, most people won't ask what the gray list has to deal with it. They'll just know they're on a gray list, and so that could cause some hesitancy in the international planning area. So again, Thailand joined the Global Forum in 2017, Inclusive Framework in 2017, which means they're implementing these minimum standards. To the best of my knowledge, they have signed or are signing the MLI, but it has not been ratified at all. And there's nothing on the OECD showing the depositing of the documents, etc. As of this morning, actually. Okay, so one more, next slide. Okay, yeah, I won't run through this too much because I'm cognizant of our time limits, but the minimum standards that Thailand has agreed to participate in, again, are the treaty abuse, country-by-country reporting, the harmful practices, as I mentioned a minute ago, and dispute resolution. I haven't heard much on dispute resolution. Most of that comes through the multilateral instrument, but I haven't heard whether that's actually whether that's proceeding apace or not. One provision in the tax disputes area, which is quite interesting, is that tax disputes that arise between jurisdictions because of a taxpayer that last over 24 months are supposed to go to tax arbitration. You can imagine Thailand is none too keen to have that happen. So we'll see where that goes. Okay, next slide. Okay, real quick, because I'm being pressured for time here. What I wanted to do is touch on some tax planning real quick for loss utilization in the last year or this past year and or this year. So a lot of companies have incurred a lot of loss, and the question becomes, well, what can we do to utilize that loss? Do we want to just hope that we're going to earn enough profit over the next 3 years to absorb that net operating loss and get the benefit of the tax reduction from offsetting our income against that? Or should we try to utilize that loss in some other one-off transaction or series of transactions? So these three examples here, asset sale, share sale, and a broken EBT, are just examples of ways that companies may actually give thought to potentially utilizing the NOLs that they've got sitting on their books and taking advantage of that. So, if you have built-in assets that you would like, especially non-operating assets, right? Especially now, if you need cash and you have non-operating assets sitting on your balance sheet, you may want to think of disposing of those. And if you can dispose of those at a profit and offset it with the NOL, then that's sort of the best possible outcome. You're getting the cash, you're getting rid of non-operating assets you don't need, and you're not paying any tax gain on that. So again, transfer pricing may apply if you do this between related parties, but there's nothing to prevent you from doing that between related parties. So if you have one company that's got losses and another one that's got gains in it, you may want to do the transaction, have them buy it, etc. The share sale one I like because this is for group reorganization. Often within groups, and it could be third-party sales anyway, but often with groups, a lot of the transfers and the sales of shares and reorganizations end up being taxable. But if you can do this transaction right now and utilize the NOL to offset the gain from the share sale, whether that's internal or third party, then it's a good idea maybe to, while you're in this space, and thinking of ways to optimize your performance and optimize your organization. Maybe you sell subsidiaries or sell some non-core businesses, etc., and move those around. The last one is an EBT. So many of us may be familiar with the entire business transfer, and you may be thinking, oh, well, that's tax-free anyway. Yes, it is. But one problem you have is that there are certain requirements to meet the EBT. And sometimes there are time limitations as far as filing the liquidation declaration, etc., that make it almost impossible to initiate an EBT, especially now that we're into December. But if you have a broken EBT, right, that doesn't qualify, and you're going to end up with some taxable gain, well, that may be okay if you can offset it with some loss, right? So some losses are transferable, some losses are not as part of the business. So again, an analysis of where you are on your losses and what might be able to be utilized inside the Thai company to offset gains on an EBT or even a partial transfer that's broken may be something that you want to take a look at. And again, it's normally people are focused on doing the EBT right and getting the tax-free, but in this case, actually breaking it may be potentially beneficial. Okay, so I've gone over my time a little bit, so I have to transition to Christine, who's going to pick it up and talk to us about transfer pricing updates. I'm sure people are very interested in hearing all about this. So I hand it over to Christine to educate everybody on transfer pricing.
Thanks very much, Jonathan. I'm cognizant of the fact that I'm standing between you and lunch, so I'm going to try and make it relevant and quick. So can we go to the next slide, please? Today I wanted to cover three things. I guess the first thing was the transfer pricing updates, mainly with a focus on compliance, because with all of the more recent announcements, they are focused quite heavily on the compliance requirements, which Jonathan alluded to, the reporting requirements, and we'll talk about that in a moment. The second thing I wanted to touch on, which transactions have been affected by the most recent announcements, and thirdly, what should you be looking to do for this year, for 2021? How does this affect you as taxpayers in Thailand in 2021? The first couple of slides I'm going to look at quite quickly. Transfer pricing journey for Thailand started back around in the departmental instruction 113 in 2002, and really its effect lasted till 2020. And under that departmental instruction, really the TRD asked you to make sure that your related party transactions between associated parties were conducted at market rates. So for example, your loans were conducted with a market interest rate. There was also guidance on what documentation to keep, which documents you needed to keep on file to prove that you were conducting your transactions at market rate. You were required to do transfer pricing documentation, and the TRD had the ability to adjust the pricing if they thought it was not at market rate back to market rate. However, because it was not based in law, the transfer pricing rules were not based in law, they couldn't penalise taxpayers who didn't do that. So what happened in 21st of November 2018, as Jonathan also alluded to, the transfer pricing rules for Thailand were encoded in law. So now there is a particular arm's length standard for transactions between related parties. That means you are required to conduct your transactions as if you were conducting the transactions between two independent parties. And because it was now in law, the TRD had the opportunity to be able to adjust your transactions back to what they thought was the arm's length range. They wanted you to follow the OECD methods in order to determine what that arm's length range should be on your loan or on your transfer of assets, etc. And then if you did not, you were also required to create mandatory transfer pricing documentation. So you had to be able to document to prove that your transactions were being conducted on an arm's length basis. And if you didn't produce the documentation, or it wasn't correct, or it wasn't complete, you could get penalised. And the penalties were quite significant, and they came with interest, and they came with other things as well. In, I think it was June 2017, Thailand signed up to be part of the OECD inclusive framework, and so they agreed with the OECD to implement certain standards in Thailand. And one of those was reporting. They wanted to increase a 3-level type of reporting to report on your transactions between your related parties. So one was local and one was master, which is more at a group level. Say, for example, in Asia, that might be your headquarters. I'm making this up, in Singapore. And then the local level might be the operation in Thailand. And then the third level would be at a global level, based on you meeting certain criteria. So you see here, the Director General notifications number 407 and 408, recently introduced in September, are starting to show us what the TRD wants to see in that documentation. And we'll talk about that in a little bit more detail. And then the more recent Director General notification number 400 came with a few more increased clarifications on how to prove that your transactions are being conducted at arm's length, and also came for a notification for the annual transfer pricing disclosure forms to be submitted online. So I'm just going to get you to move forward, please. Hello. Thank you. So just to summarise what the evolution has been in the transfer pricing documentation and compliance and other requirements, we really are finding that over time that there is becoming an increased burden for submitting transfer pricing documentation, making sure that your transactions are conducted at arm's length. So let's just look at the summary. From 2002 to 2020, based on the 1995 OECD transfer pricing guidelines, the TRD required that your transactions were priced on a market basis. They asked you to use the 5 existing OECD methods to price your transactions, whether they were for loans or provision of services or provision of products or assets. Once the transfer pricing rules were coded in law, that gave the TRD the opportunity to legally, so a legal base or a legal framework to adjust your transactions back to that arm's length range. So if they felt that they weren't being conducted at arm's length, they would adjust them back, and then they would potentially provide or ask you to pay a penalty based on not assessing and determining the correct arm's length pricing, because the responsibility is on the taxpayer to develop the method and for pricing their transactions, and they guide you in how to do that, and if you don't do that, then you are penalised. So the penalties were quite hefty. Thai baht 200,000, or that's about $6,000 US for not completing your transfer pricing documentation, or getting it wrong, or for missing parts out. The other part of that is that if you met the minimum requirement of Thai baht 200 million of total revenues in the most recent fiscal year end, you were required by law now to, at the end of each year, with your corporate income tax return, submit a transfer pricing disclosure talking about the amount of your transfer pricing transactions with each party, where those parties were located, etc. And that was applicable from the start of 2019. And then the most recent announcements were really more concerned with ensuring that we clarified the comparability. So, for example, when you are determining the pricing on your loans transaction, or if you are selling products and determining the margin on those sales, you have to use the most appropriate method. Now that includes the 5 OECD methods, but if they are not the best method, then you are able to use an alternative method, but you have to justify that alternative method as being more appropriate than the OECD methods. A couple of the other changes that were important, the prices are adjusted back to the arm's length range, which is quite a broad range, not the interquartile range, the arm's length range. On services and intangible transactions, there are now more detailed rules that you need to meet, and we're going to talk about those a little bit later when we look at those transactions. And these rules were applicable from January of this year. And I guess the only other point I wanted to make was that there's a couple of other smaller notifications, number 369 and number 370. Number 369, the last point on this slide is interesting because it talks about the TRD's preference that if you are trying to use a method to determine and demonstrate to the TRD that your applications are at arm's length, they prefer that you use, if for example you are a Thai company and you are making a loan with an independent party and you are also making a loan with your own related party, this is called an internal comparable, and you can use this to help you to determine the price on the related party transactions. So they have so the TRD now has a preference to see use of those types of transactions if they are available to help price your related party transactions. But also when you are looking at comparables, the preference is to use Thai comparables over international comparables if they are available. So that's quite a mouthful. So I hope you get the gist of it. I'm happy to answer any questions. Can we move forward, please? Can we move forward, please? I really wanted to focus on the compliance requirements. So when Thailand agreed to putting in place the 3 levels of reporting, the local reporting is the local file, and then there's the master file, and then there's the country by country reporting. And I've talked about those as being 3 different levels. Now at this stage, there's no guidance on the master file. There's only guidance provided on the local file and guidance provided on the country by country reporting. So let's quickly look and see what that is. Where you have back please. Where you have transactions more than Thai baht 200 million, or in the most recent year, you are required to prepare not only the annual TP disclosure forms, but you're also required to develop transfer pricing documentation, local file documentation. You are not required to submit it unless the TRD asks you to, and then if they do, you are required to remit the transfer pricing documentation 120 days from the date of request, or if you are being asked for the first time as a Thai company, then you've got within 180 days from the date of request. And let's face it, if you have to put in these reports, the thing you need to know is you need to put it into the person who's asked you. So let's say Jack Sheehan works for the TRD and he comes to you and he says, this is the first time you're putting in documentation, but I want you to put in a local file. You have 180 days from the day that he has asked you to present it to Jonathan himself, sorry, to Jack himself. The transfer pricing documentation must be prepared in Thai. However, if you have a fiscal year end that is finished before the 31st of December this year, then you should be allowed to submit in both English and Thai. So if your year end, for argument's sake, is in June of this year, then you can remit your transfer pricing documentation on request in either English or Thai. There are 2 scenarios under which you do not have to prepare transfer pricing benchmarking, so where you don't have to include benchmarking in your report. The first one is a whole bunch of rules together. So where you have less than or equal to Thai baht 500 million and all of your transactions are between domestic related parties and none of those companies are using carry forward in their determination of their income and they're all subject to the same corporate income tax. Under that scenario, you are not required or you don't have to prepare benchmarking as part of your reporting. The second scenario is where you have existing bilateral APAs to give you some certainty of price. For example, between, say, companies in Thailand and companies in Japan, where that APA has already been agreed with the TRD and covers your current transactions, you are not required to do any benchmarking. Now, if you don't prepare these reports properly, or you fail to lodge them, or they're incorrect, as noted, you'll be penalised 200,000 Thai baht. The one thing I did want to point out is that with the local file, the master file, and the country-by-country reporting files, in each case, the Thai TRD uses the same format as is recommended by the OECD, with the exception of the local file. Now, we haven't had that yet confirmed in the master file, so we have to wait for that guidance. But in the local file, there are 3 extra bits of information required. You are required to include a value chain, and the value chain shows you where the Thai entity fits in the whole end-to-end value chain of the client's business. They want you to draw that up and include that in the report. The second thing is that you have to include summaries of each of the intercompany agreements you have. So if you have intercompany agreements covering your intercompany loans, your intercompany services provisions, your purchases of parts or finished goods and what have you, you must summarise those and include those summaries in the report. That is not required in most other OECD countries. And the third thing that you have to do is you not only have to say, of these 5 methods, I am deciding to use this method in pricing my transactions. You have to clearly say why you are not using the other transactions as well. And then if you use an alternative method, you have to say why you are not using the 5 OECD methods, and you have to give an explanation why you're using the alternative method. Can we move forward, please? The country-by-country reporting, I wanted to spend just a little bit of time on. This one sometimes is a bit confusing to people, so I just want to take a moment on this. A multinational enterprise group globally, where they have consolidated revenues more than Thai baht 28, I think it's billion, but 1,000 million, or USD 840 million, in a fiscal year end, occurring on or after 1 January 2021, is required to submit country-by-country reporting. Let me just spend a moment on that timing. So what the requirement in Thailand is if you have a fiscal year starting on or after January, so let's just say it starts January 1 this year and it finishes 31 December this year, 2021, then you are required to submit a report, a country-by-country, and by the way, if it meets that threshold for the country-by-country reporting of Thai baht 28,000 million, then you are required to submit a country-by-country report for those transactions and for a range of the other, I'll explain in a moment what other things are in that country-by-country reporting, 150 days after the fiscal year end, so that if the Thai entity is responsible for submitting it, that would mean that roughly the 31st of May in 2022, you would have to remit the country-by-country report. Now, before I say whether or not and walk through the scenario of when the Thai entities might be required to remit it, let's just move down through the other points here so you understand what's in the country-by-country reporting. So I just want to make a point on that 150 days after fiscal year end. The OECD recommends 12 months. So really 150 days is a very short period of time for what needs to be in there. But I've also made a point here that shows you that if you are required to submit country-by-country reporting and you don't, you really only get fined Thai 2,000, which is not Thai baht 2,000, which is really not a lot. What's in the country-by-country reporting? If you have a global group, for example, a headquarters, say in the US, and entities in Thailand and several other countries in region, there is information that needs to be required for each of those entities. It needs to be submitted online, and it says what is an XML format, which is like an Excel spreadsheet. And there's very specific information that needs to be put in there. And for example, it includes high-level information, revenues, profit before tax, taxes paid, stated capital, earnings, the number of employees, assets, and cash and cash on hand. That information needs to be provided in the country-by-country report for each jurisdiction in which that group has entities. And if you have, for example, in Thailand, 3 entities, it must be provided for the aggregate. So you add them all together and you simply give an aggregate number. The other thing is you have to submit the report in the financial currency of the ultimate parent. So if that is a Thai company, all of the financials have to be remitted in Thai, to the Thai baht. Doesn't matter which location you submit the report in. And if it is, say, an Australian company with a Thai or another company with a Thai subsidiary, whatever that parent country is, all of the financials, at least even for including Thailand, will be in the currency of that country. Now let's just have a look. When does Thailand need to remit it? And I'm going to use my notes here just to make sure I've got it right. If the Thai entity is the ultimate parent company, this is the first scenario, which means that they have control over all the group companies, and you meet that financial requirement of 28,000 million Thai baht, then the Thai entity will be responsible for submitting the report, and you have to notify the TRD and let them know that you will be doing that, and then you have to prepare the report. If the Thai entity is a subsidiary of another company that is with headquarters elsewhere in the world, if that headquarters is the ultimate parent company, but in their country they don't have to remit a country-by-country report, then it might fall on be the responsibility of the Thai entity to then submit that report in Thailand. And then, and I'll come to this in a moment, the country-by-country reports are shared amongst all the jurisdictions, but we'll talk about that in a moment. If that headquarters is in a country that produces the country-by-country report, but it does not have an agreement, an active agreement in place with Thailand to share that information, then the Thai company will be responsible for at least submitting that report in Thailand at the specific required time frame, so within that 150 days or by that 150 days. If there is a failure of the headquarters country to remit the report and Thailand doesn't receive it, then the Thai entity is responsible for remitting that report. And there is a final scenario as well. If the Thai entity has been designated by the headquarters as the surrogate or stand-in parent company, then they must both prepare and submit the report in the required time frame in Thailand, but also these reports need to be shared with the other entities. Thank you very much. I'll be quick. So I just wanted to talk about that for one moment. The exchange of information requires two things. It requires Thailand to have signed the multilateral, thank you, the multilateral competent authority, which means that the Thai headquarters, the Thai tax authority, TRD, has the right to share that information with, say, the Australian ATO, with Singapore IRAS, and with all the other tax authorities. But the second thing is that it needs to be encoded in law. They need to be given the right in law. And what Jonathan was talking about before was Thailand has not done that. So here's the interesting thing. I was doing some research and I found out that, and don't hold me to this, I will confirm this for you, but I'm going to give you this information, that apparently the TRD advised the OECD that they will have the exchange of information, it will start 18 months after the end of the accounting period, when the laws for the implementation of the country-by-country reporting becomes effective, which is this year, and the multilateral competent authority agreement has been signed. So the multilateral competent authority agreement was signed last year in June. This year is the first accounting period that the country-by-country reporting is applicable in Thailand. So I have to think it's 18 months after the end of this year. Please don't hold me to that. We will confirm as that sort of information becomes available. So can we turn to the next slide, please? So let's summarise for you everything I've just said around compliance. So when is the arm's length standard applicable? When is it necessary for your Thai company to remit a transfer pricing disclosure form with your corporate income tax return? When do you have to submit a local or master file, or at least prepare them? prepare them until you are being asked to submit them? When do you have to develop or prepare and potentially submit country by country reporting file? And when is benchmarking required? So on the left hand side, if your income, your total income for the year is less than Thai baht 200 million, you are still required to comply with the arm's length standard, but you are not required to prepare an annual transfer pricing disclosure form, nor are you required to prepare benchmarking, the one at the end, and nor are you required to prepare local or master file. However, if your company, albeit a smaller company, has been designated a surrogate parent entity, you may be required to prepare and potentially remit on behalf of your global group country by country reporting. So you need to be aware of that, and that's something you need to be researching and confirming with your overseas counterparts. If your annual income or revenue for the year is greater than or equal to Thai baht 200 million, but less than the country by country reporting threshold of 28,000 million, you are required to comply with the arm's length standard. You are required to submit annual transfer pricing disclosure. You are required to prepare local and master files, even if you're not asked to submit them currently. They are meant to be contemporaneous or current. Now, is benchmarking required? Let me jump to the end again. Well, it is required unless you meet those two rules we talked about. The rule where you've got less than or equal to 500 million Thai baht, only domestic related party transactions, no loss carry forwards, and the same corporate income tax rate applies, or you've got a bilateral APA. However, it's the same situation as for less than Thai baht 200 million. If the company is designated as a surrogate parent entity, or under other circumstances that we've talked about, still might be required to prepare and submit country by country reporting. And then, of course, once you've met the threshold for country by country reporting, you have to comply with all of those points. Can we move forward, please? I wanted to just touch on the transactions that are impacted by these announcements. I'm not going to really touch on the first one. We already know from when we had the Departmental Instruction 113 back in 2002 that transfer of assets, services and funds are all covered, and they are now required to be arm's length standard, and if they are not, you can be subject to quite hefty penalties, interest and surcharges. Services. If you have intercompany services, as the TRD becomes closer and closer and closer to the OECD requirements, you are now increasingly subject to more tests or standards around some of these transactions. So for your intercompany services, you must be able to prove that there is a benefit. So if you are wanting to charge, if a Thai entity is charging its Vietnamese related party for providing services, you have to be able to demonstrate that those services are providing a benefit to your Vietnamese related party, and it needs to be a service that an independent party would pay for, would be prepared to pay for. For example, if the service that you want to charge for is perhaps your CEO just undertaking CEO activities and not really helping, not really delivering a benefit, then you will not really be able to charge for that service. It needs to be able to deliver a benefit. The other thing is, and I won't spend a lot of time on this, but there's no simplified service charge. So you need to properly look at the method you use to price the service. Intangible transactions are transactions like I license you to use my trademark or certain know-how, etc. And you're being able to use that for that transaction, I charge you a royalty. So I'm your Singapore headquarters, I charge you a royalty. Increasingly, what the TRD wants you to do is to have greater scrutiny in the way more carefully look at how those transactions are priced to make sure that there is not potentially some local benefits or some local value being created in Thailand that might mean that really Thailand should not be paying that full royalty. We need to have a look at properly ensuring that Thailand gets rewarded for any intangibles that it is developing locally. Can we go to the next slide, please? So what do you have to do? First of all, do you have related party transactions? And do you meet any of those thresholds that we've talked about, and you need to understand that if you meet those thresholds, you automatically then have liabilities to put in TP disclosure forms or potentially some sort of CBCR reporting, and you need to be aware of that. So if you have already met the 200 million Thai baht level and you are going to be submitting TP disclosure forms, this year it's going to be online. You need to register for that, and then you need to be aware that you need to submit that online. Local reporting. If your local reporting has a fiscal year end date at the end of this year, 31 December, then you will need to be remitting your Thai transfer pricing documentation when you are being asked to in Thai language, and you need to include the value chain and those other points that we recommended. You need to be talking to your counterparty or your related parties globally and understand whether your Thai entity has a liability to prepare and submit country by country reporting in Thailand. And then you need to check your transfer pricing methods that you are using to price your service transactions and your intangible transactions, especially if these are material, because these will attract a lot of attention with the TRD. Can we go to the last page, please? I'm sorry, very quickly. So just a few things that we expect to see coming. We expect to see some more clarification on the country by country reporting, potentially extending that period to 12 months. We need to, there'll be a few other bits and pieces. For example, the exchange of information. We need to see what the TRB says about when that legislation becomes active. Otherwise, there still may be a need for Thailand to have a responsibility to prepare and submit that documentation. We expect to see more guidance on the master file, on the preferred pricing for intangible transactions, and on the comparable ranges that should be used. So that's the end for me. There are some questions and answers. Do we have time for the questions and answers?
Yeah. So let's have a quick look at questions that Jamie.
Right. So could Thai companies apply this guideline? Can I just say to you, no, I've glossed over this point quite highly. There has, one of the things that was expected to be brought into place was an agreement to have a safe harbour on routine or low value services. The OECD recommends that if you have, for example, provision of IT services or HR or accounting or those types of low value services, that you can apply a simple cost plus markup 5%. Thailand did not agree to that. Right, they did not bring that out in their most recent number 400 notification. So I'm not sure whether you can really use it. I'm not sure if it would be challenged, but if I were being asked today to look at this, I would be probably going to do a benchmarking on this just to confirm. And I'd probably do a transfer, use a transnet margin method and just look at a total cost plus markup or a net cost plus markup just to confirm.
So Christine, what you're saying is that the usual safe harbour 5% cost plus markup is that the OECD talk about is not specifically.
It hasn't been agreed. It hasn't been agreed in Thailand. It's specifically not agreed in the most recent information that's come out. We would certainly hope it is. It has been agreed in places like Singapore and other locations, but it has not been agreed yet in Thailand.
Okay, interesting. You've got some more questions there, Christine, in the chat box.
I'm just going to see how to move down. Oh, gosh. Jack, could you help me with this? I'm struggling to get this thing to work.
Okay, so one of the questions is the question on country by country reporting.
Yes.
If group consolidated revenue is less than the 28,000 million baht,
yes.
Do we prepare and submit a document proving this, or do we just do nothing?
No, you don't have to. You don't have to prove it if it's under that. Really, the global trend, that it doesn't matter which jurisdiction you go to. It reflects the same. It's reflected the same in the OECD. It is only once you meet that threshold and then go above that threshold. You do not have to prepare it if you're under the threshold. You don't.
Okay. Is transfer pricing applied by companies under petroleum income tax?
Yeah, that was a good question. We already had that yesterday. I believe they're under the PITA law, aren't they? They're under a separate PITA tax law. Now, specifically if the PITA law applies to you, then the other taxes under the revenue code do not. And transfer pricing is under the revenue code. So it does not, from what I understand.
Okay, we have another one here from Abe, and Abe asked, our financial year ends on the 31st of March. So
Right.
our liability in the next year for the criteria to meet the, so I guess it's when is our liability, so when will our liability start in the next year for the criteria to meet the 200 million baht?
Right, so the 200 million baht requirement starts from January 21. So if you've got, right, I understand the question. So if you have a fiscal year end by the end of this year, then you have to prepare it. So that, right, so the Thai baht 200 million is, that's been actually applicable, if I'm not wrong, since 1 January 2019, right? So when the new Transfer Pricing Act was put into place and it was effective from the 1st of the 1st 2019, that's when the Thai baht 200 million requirement was put in place. So you need to look at whether or not you've got a complete fiscal year end after 1 January 2019. Is that clear?
Yeah, and there's another question here. How can we identify connected persons and a connected party transaction with transfer pricing?
Right, okay, so the TRD has been very clear on that. If you are a company and you own 50% of the capital of another company, they are related parties. If you are a company and you own 50% of the capital in two other companies, they are related parties. Of course they are as well, but they are related parties. And the third one is, even if you don't necessarily meet that ownership level, if there is a high level of dependency, control and management by a headquarters, say, on a company, in terms of how they do their operations, so a large portion of the control, and this is going to be determined on the facts, then that is also, so it's around dependency related to management and control.
Okay, because we've just gone over the mark for lunchtime, so I'd like to thank everybody for joining us this morning, and particularly our speakers, Jonathan and Christine. And if anybody has any questions at all, you can reach out to me, Christine or Jonathan anytime. Please email us or send us a message, and we'll be happy to talk to you. So I wish everybody a nice lunch and a nice afternoon. Thank you. Bye bye.